Morning, everyone. Welcome to our panel webinar series 3, Female Leaders in the New Norm. Today, we're going to share some ideas about how startups can change to survive during and after this pandemic. I'm Connie, a co-founder and CMO from Tangram. I've been in fintech industry for 3 years. So Tangram is the first smart wealth creating platform in Australia. It delivers in a simple and easy way for us to build your wealth faster by earning rewards from the daily spending. We are pretty honored to be the strategic partner of She Loves Tech and glad to introduce the competition to Australia for the very first year, which is why I'm here today with our 3 amazing speakers. So She Loves Tech is the world's largest startups competition for women and technology. Over the past 5 years, they have been supporting 2,000 startups for fundraising over 100 million US dollars. So we encourage the female-led or female impact startups to join us in Australia and New Zealand. So the registration is open to 20th of September, and the Australian final pitch round will be 5th of October. So we're gonna select top 3 startups and get them onto the global stage to pitch in front of the top tier investors. So we're going to start today with a keynote from Thomas and getting some questions to discuss about 40 minutes. After that, we have 5 to 10 minutes Q&A. So for everyone who is attending the webinar, please let us hear more about you, like where you're from, what is your business, and also feel free to submit some questions into the Q&A feature. So yeah, Thomas, could you please briefly introduce yourself and your company?
Yes, thank you, Connie, and thank you, everyone. And thank you for inviting me to speak this morning. I'm a commercial partner at a firm called HWL Epsworth Lawyers. So I specialize in M&A, which includes venture capital and private equity transactions. I am based in Melbourne, so I'm currently in lockdown. And we're a national firm with 8 offices around Australia. Yeah, we've been around for over 100 years. We're one of the largest firms in Australia, but we do like to support small businesses and entrepreneurs.
Sounds amazing. Hopefully, we will seek your advice, in terms of IPO, maybe next year.
Yes, of course.
Millie, so tell us more about yourself, like your company and your vision.
Excellent. Thank you, Connie. Pleasure to be here. Hi, everybody. My name is Millie. I'm the program manager at Energy Lab. We are a clean tech startup accelerator dedicated to supporting startups who are shifting Australia to 100% clean energy. So we support founders across the spectrum of their entrepreneurial journey, from pre-idea all the way through to scale up. We also operate a clean tech angel group to drive capital to startups looking at climate solutions more broadly, not just in the clean energy space.
Great.
And a large part of my role at Energy Lab is working with aspiring women founders in our Women in Clean Energy Fellowship, which is a program designed to support more women to start clean tech and clean energy startups. So it's a real pleasure to be here talking to women in tech.
Great. We are also so happy to have you with us today. Megan, what about you?
Hi, everyone. I'm Megan Capriccio. Thank you for having me today. I am the co-founder for the Femtech Collective. We are a global network as well as a hub and business support service for professionals and founders in the women's health tech and innovation space. We work quite closely with a lot of women, mainly because the end user is primarily women for a lot of this technology that's coming through. And at this stage, a lot of women come to this space from an experiential background who are wanting to create technology to help their own experience and their health journey, as well as other women experience similar symptoms. So we do a lot with amplifying women in the space, mentorship programs, networking, as well as making sure women's health tech is a tech category that's developing throughout Australia.
Great to have someone like you to support more female entrepreneurs, and also especially in health tech, that's this area. So yeah, Thomas, since you specialize in corporate and commercial law, mainly in the area of PE and VC transactions, could you please share your insights on that for all of us?
Yes, sure. So I have prepared a short presentation. So just bear with me while I share my screen. So again, thank you very much for the opportunity to speak this morning. My presentation is called 5 Minutes Insight into VC Transactions. Now, given the time constraint, I'll go into it straight away. So the first slide is called VC and PE Funds Entry. This is a useful diagram as it represents the entire life cycle of companies from startup to public market and secondary offerings. The red curve represents the revenue of the target. The green arrow represents investment window of VC funds, while the purple arrow represents the same for PE funds. You can see that there is some overlap around second and third stage of the target's development. Other than that, PE and VC funds operate in different domains. And if you're, in case you are wondering what the FFF acronym stands for, depending on your sources, it may either mean founder, family, and friends, or more cutting, friends, family, and fools. So there have been many academic studies on investment criteria for VC funds. One of the most lucid ones include the following: market attractiveness, product differentiation, managerial capabilities of the founders, environmental threat resistance, such as barriers to entry, a competitive entry, and cash out potential. The funds will also consider how an investment will fit their existing portfolio. Most businesses in Australia operate as sole trader, partnership, discretionary trust, unit trust, private company, stapled security structure, unlisted public company, or listed public company. Not all of these structures are conducive to equity capital raising. For example, it is not possible for a sole trader to raise equity capital in itself. Partnership has its drawbacks too. Joint and several liability nature of partnerships do not work for certain investor types such as VC and PE funds. Discretionary trusts do not allow for fixed entitlements, as such do not work for external investors. Now, in order for such business structures to facilitate equity investment by investors, they will need to be restructured. Now, before you undertake any restructuring though, you should consider whether there are any tax rollover reliefs and/or tax concessions that may be available to such structures and may be undertaken and the restructure undertaken without triggering commercially unacceptable tax consequences or by deferring the taxing point. Unit trusts, private companies, and staple security structures do not suffer the same structural impediments as the earlier structures mentioned. However, certain types of investors may be uncomfortable with either actual or perceived legacy issues associated with investing into an existing company or a unit trust and require the relevant business or assets to be rolled into a clean entity. In Australia, public companies, whether listed or unlisted, attract additional regulatory oversight in terms of the Corporations Act, financial reporting requirements, and audit requirements. Takeovers provisions and fundraising provisions of the Corporations Act will be relevant for unlisted and listed public companies, as well as the listing rules once a company is listed. So in terms of the common equity funding mechanisms we see in Australia, they are as follows. So pref equity is a form of hybrid of debt and equity financing. Pref equity would generally have a coupon rate, but it is not a guaranteed return, although they may be cumulative. There would also be limited voting rights, generally limited to circumstances where the rights of preference shareholders would be materially adversely affected. and priority to ordinary shareholders in distribution and winding up. Preference shares may also be redeemable. Redeemable preference shares may be redeemed without having to go through the statutory processes under the Corporations Act for return of capital or share buyback. Convertible note is also a form of hybrid of debt and equity financing, but retain more characteristics of debt with interest rate and maturity date. Convertible notes may be converted to ordinary shares at either a predetermined conversion price or based on an agreed formula. A SAFE, which stands for Simple Agreement for Future Equity, is an agreement between an investor and a company that is akin to a convertible loan without the debt element. Under a SAFE, an investor agrees to make a cash payment, which is not a loan, to a company in exchange for a contractual right to convert that amount into shares when a pre-agreed trigger event occurs. The trigger event is usually the closing of a priced equity round. Following a liquidity event, an investor can usually choose to either receive their investment amount back or convert that value into shares. SAFE is a relatively new form of financial instrument, but are frequently used in VC transactions as they are allowed as financial instruments under the Venture Capital Act. That is, SAFE is recognized as an eligible venture capital investment under the Venture Capital Act, as well as the Income Tax Assessment Act. It is commonly held to have the following features. There will be no maturity date, no interest rate, automatic conversion on trigger event or at the election of the investor, and a valuation cap. That is, there will be, it would outline the maximum value to which the SAFE will convert. Well, this concludes my 5-minute presentation. Hopefully it provided some insight into what the VC funds are looking for and the applicable funding mechanisms that may be applicable to this, to the entrepreneurs.
Thanks, Thomas. That was very helpful, and I think although the audience today, they probably come from very early stage, but I think it's better for us to have a better understanding of the funding cycles and also the business structures, what we're going to face maybe in the later stage. And also I think we both agree that how do I say, the investors, they are getting more and more conservative. So probably, Millie, I know that you have been running a clean tech angel group at Energy Lab. So from your perspectives, are you seeing any changes, in early stage funding, and tell us more like what's happening with angels and early stage startups?
Absolutely. Thank you, Thomas. That was a great presentation. So Connie, yes, in absolute agreement with you, we have seen certainly lower valuations and a decreased risk appetite throughout the pandemic. I think that valuations have decreased due to COVID, more specifically the economic impact and expected economic impacts of a recession. We're certainly seeing a changing risk landscape in the sense of an increased risk aversion in angels. This really means an increased reluctance to invest in any startups pre-revenue. It also means that investors have been demanding a higher degree of confidence in the startups that they do invest in. So they're applying more scrutiny, due diligence processes can be longer. They're more selective with the founders that they back. So they might be looking to invest in founders who they know who have proved themselves in the past. And in the future, this increased risk aversion may make more active participation from angels. So I think we might see angels becoming a lot more involved in the strategy and the decision making of the startups that they do choose to invest in. Another thing that will probably come out of this pandemic and the move online is that themed angel groups might make it easier to find aligned investors for startups, because essentially before COVID, there was a marketplace with a finite pool of, angel groups were city specific. And angels were only interested in local companies because they could meet these founders in person. COVID's really changed that. Now that everything's online, startups are able to apply to pitch in cities that other than their own. So we will probably move away from these location-based angel groups and more towards themed angel groups like clean tech, femtech, fintech, etc. So what this means for startups is that you'll have a greater chance of finding early stage investors who are aligned to your sector and share your purpose and understand your market. So I think what this means for startups now and moving into the future is that angels will continue to invest, but in general, expect probably smaller rounds, lower valuations, greater competition now that everything's moved online, and more scrutiny and more involvement from investors. Also, when raising funds, I think it probably goes without saying, but be prepared to answer a lot of questions about your COVID and your post-COVID strategy. You should be able to answer questions around how you can survive the crisis over the next 6, 12, 24 months, and how you're going to get more from your existing runway. Interestingly, our Clean Energy Angel Group has not seen a reduction in deals being made. We've actually hit records in recent months, record number of companies applying, record amounts raised, and in record times. So that's the energy space. Megan, I'm wondering if you're seeing similar things in health and femtech.
Yeah, I think that health is really top of mind at this stage, especially in technology that can allow individuals to better manage and track their health from a personalized perspective. When it gets deep into very specifics of women's health, there's definitely interest, but it is taking second precedence to things, to technology and innovation that is helping more specifically with infectious disease or specifically the COVID epidemic. But what we have been seeing is that because health is always going to be something that needs to be managed no matter what is going on in the world, that technology is filling the gaps where that is making it more accessible for users and patients despite the pandemic. For instance, a lot more investment going into telehealth services, personalized healthcare that can be done virtually, subscriptions and prescriptions done directly to your home, different areas in that aspect. A lot of that can be across various health solutions. So it can, there's a lot in Australia with contraception straight to your door, telehealth to support women through menopause that are in rural communities and don't want to travel to cities where infection of COVID might be more prominent. So we are seeing a lot more investment to support women's health tech as a secondary option, really to make sure that the healthcare system isn't overloaded with other options, and it can really focus on the pandemic at this stage.
Yeah, I think you both really made a very good point. Like Millie, you mentioned that actually the investors, they are becoming more proactive to look for those startups with great ideas. Doesn't matter like where you're based in. For startups, they are able to access to a bigger financial pool than before. But on the other hand, I think that the valuation, especially tech companies that have been dramatically decreased, and only 3% startups they think the valuation came back from VC matches their expectations. So Thomas, based on experiences, what is your thoughts on the valuation metrics? Any key drivers of the value that startups should be aware of when they are to be the lucky one and have a deeper conversation with the VC or PE?
Yeah, as Millie and Megan have mentioned, I think it might have been Millie, about the deal flow. Certainly we haven't seen any reduction in the activity in VC space, but the number of deals that have closed have certainly dipped in 2020. And one of the consequences of COVID-19 has been material reduction in the valuations of some of these businesses, in particularly in certain sectors. We're seeing close, somewhere between 20 and 40% reduction in valuations in some instances. And we're also seeing that there have been, some temporary and regulatory structural changes in the VC space, which has also impacted on the deal flow and also in terms of the valuations. So by way of example, since end of March this year, Foreign Investment Review Board monetary threshold has been reduced to 0. And that change is likely to stay in place until January next year. So a lot of deals which would otherwise have not been, would have required further approval now need to go through that process. And as you know, a lot of VC and PE funds would have overseas investors or capital raising that have involved foreign investors. So and that has just meant that more added cost and delay associated with VC transactions, VC and PE transactions, which has had a cooling effect on these deals. In the past, you would have safely used certain market conditions that produce the track record as the sort of basis for evaluation and so on. Where that's been disrupted by the pandemic, that's obviously something that's materially impacting on VC transactions. Net asset value of funds have been affected by the pandemic as well. And we are also aware that certain funds have had requests from certain investors seeking release from their commitments and wanting to sort of seek earlier redemption as well. So that's also had a flow-on impact on the liquidity and diversification of the funds. So look, overall, it has been a very difficult year for VC and PE transactions in terms of closing the deals. But we're sort of positive that the deal flow and the number of deals that will close will sort of pick up in the new year.
Yeah, thanks for sharing that. Actually, because we are looking for funding as well, so I can feel that a little bit. The investors, they're having a bunch of angles to evaluate your business at this uncertain period to secure themselves. Like you mentioned, something like a compliance cost, that definitely will slow down the process. So we need to focus on a long run funding process. It's not going to be several months, but more likely to be years time. So this kind of situation comes out. Another issue for startups is probably surviving is going to be the key, because we never know when the next dollar is going to come. So for startups who have some doubts with the existing business model and looking for some new pilots, how can they involve the core value to embrace changes? What is the game plan for them to stay alive? And anyone want to jump in on that? Probably Megan, let's go with you.
Sure. I have found, and I can only speak to the FemTech space specifically, but I have found that companies that have kind of rolled with the punches, seen the opportunity of the world changing, and showing their resilience through that are really going to be the companies that can be flexible in times of crisis. And that's worldly societal crisis and also business specific to them as well. So companies that I've seen in this space who have offered or have new offerings or services that are specific to the pandemic, as well as I mentioned previously, like telehealth services, but also are acknowledging the different partnerships that they can make across the sector to give a holistic approach to health. So not just services that are specific to women, but also may compound with an infectious disease or the pandemic is really something that is developing in a really great way. I've also seen that the companies that are thriving are, again, realizing that this is an opportunity to really show how they are developing to give a social impact component to the business that they're creating. So I think a lot of the panelists can attest to that with their backgrounds. But I think the world is in a stage where it's not, yes, of course, capitalism is going to persist. But I think users really like to know that they have purchasing power that is going back to a social impact component. And if we can compound those two things, it's really a unique selling point that is really going to allow these companies to thrive.
Yeah, thanks. Great to know that. That was very inspirational for those startups who are still, a bit confused about how to adjust themselves to this new situation. And great to know that what you're suggesting is actually startups, they really need to be careful of how can they build more touch points for the customers, because we all know that COVID-19 has reshaped the customer behaviors a lot. So yeah, Millie, let's drill down that question a little bit deeper. I know that you have been coaching many female entrepreneurs to find out a way to deliver their core values efficiently. Apart from that, you are also a co-founder of a medtech startups. So could you share your experiences on how are the approaches taking in acquiring new customers, like building more touch points or locking existing ones to help them to find a sustainable revenue growth?
Yeah, thanks, Connie. I think the pandemic is really a unique opportunity to connect with customers. We've heard it so many times before that we're in strange and uncertain times. And I think companies and startups that lead with empathy and genuinely address customer needs at this time can do really well. I think customers will remember the brands that were there for them during this time. I think there was a period early on in the pandemic where a lot of startups and brands and big businesses were having difficulty figuring out their message. Should we be even selling things at a time like this? And I think now we've emerged to a new phase where customers really want brands to acknowledge that this is a difficult time. They don't want brands to just sell them things superficially. They want brands to provide a solution to their pain points. So we want trust, we want happiness, we want hope from startups at this time. So how can you position your brand now to have really a long tail in terms of payoff into the future? And as I said, customers are going to remember brands who are there for them. So in terms of acquiring and acquiring new customers and locking in existing customers at this time, I think sort of the same strategy applies. Understand your customer profiles deeply and the associated jobs that each of these customers are trying to get done and their unique pains and gains, and then consciously provide empathy to your customers during this time. Hey, customer, I'm checking in. I hear you. I see your pain, and I've got this particular solution to your unique problem. And then in terms of branding exposure, make sure you're reachable. Obviously, make sure you're available online. Make your online brand really loud and clear. Because if you can build trust with your customer at this moment in time, you will be very well served for the future.
Thanks, good to know. Definitely, this is a tough time for all of us, especially as the entrepreneur of startups. So I think you mentioned the one that is very important is how to position yourself, how to position your branding, how to know that your customers really need this. The things that you are developing is really very important. But the fact is, there are also tons of failed startups who have left the market already due to some reasons, like they have made wrong decisions, wrong strategies or timing. So Thomas, let's get it to you this time. I know that you have been dealing with many cases like IPO, M&A, but you also have done some cases like liquidations and insolvencies. So should you give us some flags or alerts, like what mistakes should we be avoided in order to be ready to attract more investors?
Yeah, look, there are a lot of failed cases in this space, and often what we find is that it's not due to inability to source investors necessarily. We often find that with failed startups, it's been the founders' inability to establish good relationships with the relevant stakeholders that creates unnecessary angst and division, and also then creates issues with follow-up capital raisings. We've had in recent instances, investors taking legal action against a lot of these startups, which is could really kill the business, particularly because one, the costs involved, but also the distraction it is for the management. But also we've seen instances where founders and co-founders disagree, and there's no proper framework or understanding on how those differences can be managed. And that may also, ultimately lead to winding up and liquidation of the business. And also not being able to, align their interests with those of the key employees as well. So not being able to, resistance to provide equity. And obviously equity also needs to not just work from a commercial perspective, but also from a tax perspective as well. So unless it's structured properly, it could actually give rise to income tax liability for the employees who receive these shares. So, yeah, so I'd say, often what we see and the disputes arise because of those factors in startups.
Yeah, thanks so much, Thomas. That was extremely helpful for me because we are always, talk about how can we be successful, and we are looking up those to those big companies, but barely we actually thought of, how we can protect ourselves to, through the risks, through when we face the challenges and risks, so that we can have a smoother way to achieve the same goal. We have been giving some advice on those entrepreneurs on a pretty early stage, but there are also some audiences that are still in MVP development phase. So which means they even don't have, a team or visible product, or if the nature of the business requires a longer time input prior to the product to be visible. Is it a good time for them to enter the market? Is it like more crisis or opportunities? If not, should they stop just to be a sideliner and wait for, a good timing and start the business again? Maybe they can do this later. So anyone want to share something about that? Megan?
Sorry, I don't think I fully understood the question, so I might have the other panelists hop in before I chime in, if that's okay.
Sorry, that's a lot of questions. So
I can hop in. I can hop in. So in terms of startups in MVP stage, I think that COVID is going to be, COVID and its lasting effects are going to be around for who knows how long, let's say the next 2 to 3 years. And I think if your business is better in a non-COVID environment, then your question should be, should we participate in a follow-up round to get to the end of the pandemic, or should we shut down? And if you think you can add value in a COVID world and can continue to gain traction and momentum despite the current circumstances, then keep at it. I think it's really case dependent. If you're getting excellent customer validation for your MVP and there's proof that you're solving a real pain point and people really want to buy what you're producing, then forge ahead. Great startups are often created in a time of crisis. Airbnb, Square, I think Stripe were all founded in the GFC. This pandemic is very different from the GFC because not all companies are losing out. Some are going crazy and experiencing more demand than they even imagined. Zoom, for example. So there's always money for the right product and well placed to solve a particular customer pain point. So if you've done your scenario testing, if you've done your back of the envelope modeling, if you've tested all your assumptions and you're getting great customer validation, then absolutely 100% go for it.
Really love your idea. Like the money is always for the great products. Yeah, when we are talking about something like a financial issues, or we need to make some big decisions, important decisions, management issues, it is very important for us to find the right person to support you as well. There are so many skills that we lack. You really need to have someone or something that comes from your networks. So I know Energy Lab and also Femtech Collective has many programs to connect early stage female innovators around the whole world. So here's the question for both of you. How do we leverage our networks during this challenging time? In what way does that contribute to the businesses? Do you want to share something like that? Anyone?
Yeah, I might jump in here. Yes, there's a couple of things you mentioned there about how to properly network and mentor, and how that can help with finding a co-founder. And I would even extend that to an advisory board and a team as well. In my first business, I was very privileged that my co-founder was my brother. I don't think every brother-sister pair can do that. That's not to say that we were perfect all the time, but it happened. It worked for the time being. And I think right now, if you are thinking about finding a co-founder or extending your advisory board, you're going to have to be more aggressive with networking, because in this age, you don't get to just show up to an event. Even an event like this, there's less socialization among the attendees. You're really going to have to do your research, network via LinkedIn, or find opportunities that allow for virtual networking. So at the Femtech Collective, we do have a mentorship program, and we're launching a networking program next month, to specifically build the community in the femtech space, because we're so siloed at this stage, and to ensure that the development continues. The main reason for this was to ensure that exchange of ideas continues and doesn't come to a halt, but also because there's great value in our community. And by not being able to connect and learn about different stories throughout women's health and creating a business in this space, it's really putting halt on some of the connections. So I would suggest finding a program like a couple of these are quite valuable. But I think the other aspect of it is with networking virtually, if say that's via LinkedIn or what have you, you can be more strategic about it. You can research who you're linking with, who you're networking with. And when it comes to finding someone that's a co-founder or an advisor or whatnot, take your time. Make sure it's the right fit, personality-wise and skill set, so that it complements you and your business. And you don't have to jump into it without really doing your due diligence.
Great to know. So you're suggesting we need to find a network, the right tribe, so that they can adding some value to us, and we can adding something back as well. So let me turn slightly to a gender issue, because it's She Loves Tech. So the research shows that women's networks are typically less effective than men's in terms of the actual value that we get. Thomas, since you're very lucky, you're the only male speaker, and I'm so curious about what your thoughts on this. And from a man's perspective, what do you think are the reasons behind that? Any differences like with men's networks and the women's networks? Just a few for you to talk.
Yes, personally, I haven't been involved in many women's networks, so difficult for me to comment personally. And look, to be honest with you, I'm not sure it is correct that women's networks are not as effective as men's network. But I think it's fair to say that there are still inequalities, and probably more so in certain parts of the world, between women-led businesses and male-led businesses. But look, it's great to see that there are so many positive steps being taken around the world, and great initiatives such as She Loves Tech, really supporting female entrepreneurs. which I think will no doubt assist in rectifying any sort of imbalance and perception of ineffectiveness with women's network. Clearly, men and women are different, and we have our strengths and weaknesses. But I think I act for many female entrepreneurs. They're very effective. They're very intelligent, and they're just as successful as. So I don't necessarily know where that sort of research has come from, but I think there are a lot of positive steps taking place at the moment, which hopefully would rectify those perceptions as well. And if they are real, then to rectify them.
Yeah, I might piggyback off of that as well and say that I know in my space, a lot of the professionals and founders in the space are women, mostly because the end user is also women. I do have personally found a lot of interesting collaborations, willingness to exchange resources and what have you. But I would be interested to push back on that data as well, as Thomas was mentioning. And maybe it's less that women's organizations or networks are less effective, and more that blatantly women don't have the power. And if they are siloed in just female organizations or networking events, they are using the power they have and the resources they have to help other women, but it's not going as far because just how society is standing at this stage. So maybe the best way forward is a bit more inclusion across the genders, to spread the resources, the capital, the connections, what have you, across genders, and really make sure that even though, of course, women's organizations and networking programs have their benefit, preaching to the choir is only creating a band-aid to creating a solution for women in this space. Ultimately, we are going to have to create better allies with all genders to ensure that the capital and resources are distributed equally.
Yeah, I agree with that, Megan. And I also think, we run a Women in Clean Energy Fellowship because there are hardly any women founders in the energy sector. You pair energy and entrepreneurship together, two classically male-dominated spaces, and you get very, very little female founders in the space. We would love to not have to run a Women in Clean Energy Fellowship, but I think like what you're doing in the femtech space, these networks and environments are necessary as a first step. And then hopefully we get to a point one day in the future where there is equality across the board, and we these spaces become redundant because everybody's networks are of equal strength.
Yeah, and again, I would just piggyback off that as well. It would be fantastic if the word femtech no longer had to be relevant.
Yeah.
Technology. We have to use the term to bring more attention to women, and the same goes for women's fellowships and networking organizations to show that there's such a lack of it right now. I think what we'll see is once we have found success, these programs won't longer be necessary.
Yeah, here's hoping.
Someday.
Yes, actually, it's not because the network for women is less effective. It's something about because we have less female entrepreneurs. So it's pretty important for us to have some communities or networks like Femtech and Energy Lab to incorporate businesses with part of women's life. That is very important. And the most important thing is how to present your message, build up your image, public with businesses, and give them the impression that you want to live to make the network to be more effective to you. That is very important as well. So I guess for all of us in this webinar, women in particular, we have a better understanding of why building a supportive network is extremely important when you face some challenges. But if you want to overcome it, you also need to have a team that is very resilient. It's not going to be a one person's game. So like all of you have mentioned before, it is definitely team resilience is always the key strategy for any level of businesses. So anyone want to share your thoughts on how to build a resilient team that responds to those unexpected circumstances quickly and efficiently? Probably let's go Thomas this time. Any tips for you from an advisor perspective?
Yeah, so look, in advising startups, what I've found is that those who are able to adapt quickly and also maintain good relationships with different stakeholders are really well placed to cope with the current situation, but also come out of COVID, in good shape, relatively unscathed. And that sort of means, as you said, working as a team, being able to motivate staff members during this difficult period, nurturing their physical and mental well-being as well. So I think, so resilience can mean a number of things, but I think adaptability is an important aspect, particularly during this challenging times.
Yeah. Anyone else want to talk about this question as well?
Yeah, I think entrepreneurs, as a group, really thrive in uncertainty. That's why they're entrepreneurs, right? Otherwise, everybody would be an entrepreneur. And I think the challenge here is to make good decisions in increased uncertainty whilst managing the various levels of psychological chaos in your team so that they can perform at their best. We haven't been in an environment like this before. We're living in tiny boxes of our four walls. We're on our screens all the time. Everyone's struggling with a plethora of different things. And I think the most important thing that a leader can do now to help to build resilience in their teams is to really create the psychological safety, be empathetic, meet people where they are, be generous in spirit, be authentic, promote openness in your team, and be transparent. I think transparency and honesty about the situation is really important. It's also important, and Thomas spoke about adaptability. I think adaptability is really key, to be adaptable yet decisive, and create some certainty for your team amongst the uncertainty. And I think this where scenario testing can become really helpful, right? You should use it in an iterative fashion. So it's a constant cycle between imagining the future and acting in the present. And when you make a decision to act, you act and you communicate that transparently with your team. You're iteratively moving forward, which increases your ability to sense and adapt to the future, which will increase your resilience moving forward.
Thank you. You made a really good point that the adaptability and transparency, that is a key. And I think both of you have mentioned that founder or leaders, is very crucial at that stage because they are the key person to lead the team to be more motivated and keep them moving forward. And also the journey of being a founder is always, quite lonely. They have been in a crisis mode like every day. So Megan, I think you have some programs that support for women to manage their health. So do you want to talk about this as well? Like being a founder, once we have some really tough times like now, how can we manage the pressure and the mental health? Could you share something like that as well? Thank you.
Yeah, I think what's interesting about the women's health space, and even just more broadly, the acceptance of your whole self, bringing your whole self to work, especially in a very strange work from home, mandatory ISO era. There's less, I think, pressure to be the perfect image. I think being able to adapt, like Thomas and Millie had said, to the scenario is really important, but also acknowledging that for founders and leaders in the space, that showing up as human is probably the most relatable thing you could do for your team, and acknowledging that, your kid is on your lap and your dog is in the background playing with what have you, and it's your whole life and your work is one aspect of it. and being able to juggle it that way is really going to allow you to continue forward, and as well as set an example for your team as well. It's going to really help your team to understand that work is, again, one aspect, and it's allowing the team to show and understand a bit of empathy amongst the team, as well as for you to better understand the realities of your team members and them to better understand you going forward.
Yeah, okay. Thanks, Megan. It was very helpful and really benefits all of us. Yeah, so probably we have our last question. Since we are short of time, probably 30 minutes or 1 minute for everyone, what are the top tips that all startups should do in order to survive from this pandemic if they are not planning on leaving the market? Let's begin with Millie and then Megan, Thomas. Millie, yeah.
Sure. So I think the number one tip is to do just that, is to survive. It's really impossible to predict the future, but it's really important to take measures to future-proof your startup. So think through all the possible things that could happen to your business in the next 12, 18, 24 months and beyond, and how you're going to react to those situations. Is your revenue highly volatile? When will you need to raise money? How much and what for? Is there a scenario where you don't need to raise money with these really low valuations? Can you kind of hit pause and, you know, run at a really low burn rate and crank back up again when COVID is finished? I think in a high growth environment, you can grow and test a lot of things and have a much higher burn rate. But in the current environment, you really need to stay focused on your core offering, and exactly what you need to do to stay alive, and try and make your runway last as long as you can. And then stay focused on your vision, provide great leadership to your team, and best of luck. And take care of yourself as well. Your startup needs to survive, but you need to survive also.
Yeah, exactly. So Megan?
Yeah, I think Millie hit all the key points. I think I would just add, you know, she said keeping to your core product, but I would also say assessing if your core product is manageable and able to survive in this new environment. Maybe it's a side revenue stream that is actually going to continue allowing you to survive. Maybe also you need to be functioning a bit more lean. So those side offerings or services need to be put on the back burner until the team can cope. I think it's really assessing your business and your way forward to understand if it's suitable for the current environment. And I don't think we should at all take advantage or not expect that this is going to be the way forward. I think we think of it as it might come to a full stop in the future. I'm not confident that's going to be the case. I think this really might affect the way economies are going to react going forward. They're going to want to know what the health risks and safety precautions are for your business. And if you're running a in-person event business right now, you might need to adjust that to the new norm and anything similar.
Yes. So it's kind of like, you know, adaptability for both the business and also the founders as well. Yes,
yeah, that's right.
To adapt to this new normal, definitely.
Yeah.
Yeah, Thomas?
Yes. Yes. What I've found is that the entrepreneurs and startups who stay focused, I think, are a better place to survive through these challenging times, and also being effective with your time. A lot of distractions at the moment, and spread yourself too thin. I think both Millie and Megan might have mentioned that, you know, the jurisdictional constraints have largely been erased because, you know, everyone's doing meets and and pitches over online. So, but that has also meant that there's been increased competition for a finite capital. And I've seen, you know, some of my clients effectively, you know, in days and days of follow-up pitches and meetings and so on. And they are sometimes losing focus as well. So I think it's important during this period, yes, staying focused, but also be effective with your time.
Good, great to know that. Thanks, Thomas, Megan, and Millie, and thanks for everyone attending. So, alrighty, let's move on to the Q&A session because I can see there are a bunch of questions already. Let's see what we have got now. We got a question for Millie. Millie, so either for technology-related early-stage startups, what types of business will be more popular in the marketing in post-COVID-19?
What types of businesses will be more important? Popular. Yeah, sure. So I think in terms of business models moving forward, or businesses moving forward, a lot of traditional business models we've seen have suffered tremendous losses during COVID. Businesses that typically rely on physical capital or human capital have really struggled. So I think this pandemic has highlighted the lack of resilience of these business models when compared to digitally centric business models. So in terms of businesses that are going to do well, I think we really need to look at how consumption and consumer behavior patterns are changing currently and into the future, how we work and learn, how we shop, how we entertain ourselves, how we stay fit and healthy. And the answer to a lot of these questions is centered on the online environment. So I think business models that rethink the role of physical assets and humans in a transaction will do really well. So I guess my advice then to startups is make sure you can operate well digitally and have a digital presence. Ask yourself how you can connect with your customers in a new way. And as Megan said before, ask yourself if you can change the way you deliver value to your customers. So if you can pivot to leverage your core competencies and solve current problems in the pandemic or future problems that will exist in the new normal, then absolutely think about doing that.
Yeah, good. We got another question for, I think for Megan. That question was from Wendy. Thanks for the lovely presentation. I have a question for Megan. Any advice for early stage startups on building consistent and reliable performance during the pandemic?
Yeah, it's a tough question. I guess it's really going to depend on what performance you're specifically chatting about. I think this really comes down to resilience in this space. Sorry, I'm still looking at the question as well. But really adapting to the current environment is going to be a huge aspect for this. So I think we chatted about this previously. As far as reliability, making sure that your product can withstand and can be adaptable to users not being able to be in person, I think is the big one. But also especially when it comes to health, making sure your product is clinically data backed is going to be a key thing. It's always been a key thing, but now more than ever, making sure clinical trials are on point. Users really want to see at this stage that there's evidence for your product, especially if it's going to be personally managed. So that's specific to my space. I think the other two could probably also chime in on this question if there's interest.
Thanks for that. And hopefully, Wendy, that answers all of your questions. And also we have one more for Thomas. For those startups who is thinking about exit the market, what tips or advice will you give them if they are planning on leaving the market?
Yeah, sure. Look, exit can mean a number of things. So depending on what sort of stage, life cycle you're in, it could be an IPO, or it could be a trade sale. It could be a joint venture or merger with another business. And really these different structures will have different implications in terms of how much value you're realizing now and how much value you will be realizing later. But in all these, regardless of what the mode of exit is, or the liquidity event is, I think the important thing to realize is that there will be scrutiny over your business. So if you're able to get your house in order, so and professionally, lawyers use the term due diligence. So if you're able to sort of look at with critical eyes, financial, undertake financial due diligence, and perhaps look at your legal structures and framework, undertake some operational DD. And what that will do is will assist you in allaying any sort of fears a potential investor may have with your business. We'll also prepare the founder and senior management for potential issues that may surface during investor due diligence. And importantly, it allows the founder and the advisors to formulate some mitigation strategies to ward off any challenges to the valuation that the founder has attributed to the business. Because not as you can appreciate, all businesses will have some things that they could have improved on or they can improve on, and external investors will always look for issues which will then put pressure on the valuation. So being aware of what they may be, it means that you can, one, address them, but also you could sort of come up with some strategies to mitigate those discussions.
Yeah, great to know. So thanks again. Thanks for everyone. Thanks for our amazing speakers, and you have given us, many great tips. Hopefully that values a lot to all of our audience today. And this is the final series of our SheLabs Tech panel webinars. The upcoming event is the mentorship session for our shortlisted startups and also the Australian final pitch round on 5th of October. So we will have 3 winners of winners startups to represent Australian tech startups to pitch in front of the top tier global investors. Please do not hesitate to apply at the startups or audience. We are looking forward to seeing you in the final pitch round. Please do not forget that the registration is, the deadline is 20th of September. So only 1 more week to go, so hurry up. Again, thanks for our amazing 3 speakers, Millie, Megan, and Thomas. And thanks for everyone today. Glad to have this webinar with you. Have a nice weekend then. Thank you.
Thank you, Connie. Thanks, Megan. Thanks, Thomas.
Thank you.